the Sahm rule is now moved up to a level such that going back to 1960, anytime it had reached this level, there was a recession that was imminent. Hey everybody, welcome back to the InFi podcast. In this episode, I am going to take you through various recession indicators, namely the so-called Sahm rule and the inverted yield curve, both looking at the 10-year versus the 2-year Treasury and the 10-year versus the 3-month Treasury. And I'm going to relate it to the recent Federal Reserve rate cut announcement and just tie it all together, just kind of give you the framework that I've been using here at the InFi podcast or at the Infineo website, just to guide us through this macroeconomic environment. Partly, it will convey my views as to, is a recession still on the horizon? I think the answer is yes, just to cut to the chase. But beyond that, just so you can see how all these things fit together, and I'm sure a lot of the commentary you've been looking at has been talking about these things. So here I thought I'd give like one layer deeper into the analysis just to kind of explain some things that maybe you haven't seen spelled out before. Okay, so first order of business, let's look at the so-called Sahm rule. And so here, this is a chart coming from Fred, which is the St. Louis Fed's graphing tool. And you can see that it calls it the real-time Sahm rule recession indicator. I'll just read here. Sahm recession indicator signals the start of a recession when the 3-month moving average of the national unemployment rates rises by 0.5 percentage points or more relative to the minimum of the 3-month averages from the previous 12 months. Okay, so it's basically big picture. It's just sort of a momentum play. These are my words. It's named after Claudia Sahm, an economist, and that's S-A-H-M is how you spell her name. And the idea is just that when the current moving average of the unemployment rate rises above sufficiently the minimum from over the past 12 months of a certain combination of those averages, then a recession is imminent. And so you can see here on this chart that we're displaying where the gray bars signify a recession, and this is, of course, based on the U.S., you can see that when the recession kicks in, this so-called Sahm rule indicator spikes up. All right. Now, the problem with using this as a leading indicator, as you can see from this chart, is it doesn't lead by very much. All right. Really, what happens is once that blue line starts going way up, you're already well into the recession, arguably even at the tail end of it. All right. But what I will say is right now, as I'm recording this, the latest monthly measurement was from back in July, and it's at 0.53. And just going backwards, back through 1960, at no point was it ever at 0.53. Oh, excuse me. It's 0.57. And there was one more data point in there that I missed. So it's August is the latest one they have, which makes more sense because we're in September now. And it's 0.57. All right. So even more so, going back to 1960 on this particular display, anytime the Sahm rule indicator as measured on this chart was at 0.57, there was a subsequent recession. Okay. So just so you understand what I mean, there are a few places, if you're just eyeballing this, for example, in November of 1976, it popped up and it hit 0.5, and there wasn't a recession for several years after. Okay, so it's not unheard of, especially after the tail end of a prior recession, that it goes down and then pops up a little bit, and then goes back down, and you can still go years without a recession. But I'm saying even there, it was only, as I say, 0.50, whereas now it's a bit higher, okay, than that. And so again, just big picture, looking at this particular indicator, if we're just naively looking at the charts, anytime going back to at least 1960, when this thing has gotten to this level, there has been an impending recession. All right. But again, this is more sort of a momentum argument. And what I mean by that is simply it's kind of just showing once unemployment starts ticking upward sufficiently, then nothing stops this train. Then it means, oh, you're going into a recession. Okay. I'm personally sympathetic to the so-called inverted yield curve indicators. So let me first just show you the charts, and then I'll give you some of the theory behind it. Okay, so there's two popular measurements when we talk about the inverted yield curve and whether it's going to signal an impending recession. And they both use the 10-year Treasury as the longer yield, and then they differ in what the short yield is. So one popular measure is to say, look at the yield on the 10-year Treasury versus the 2-year Treasury. And so here, this is the chart now indicating that. So this blue line is just the difference, right? This is the yield on the 10-year minus the 2-year. So wherever it's above that dark black line, that's the zero axis, that's showing areas where the yield curve is upward sloping because the 10-year is bigger than the yield on the 2-year. So that's why the 10-year minus the 2-year is positive. All right, so that's what is, quote, normal. And you can see, though, historically, so this particular version I have goes back to 1976. You can see that whenever that line goes negative, right, goes below that black solid line, those are regions where the yield on the 2-year Treasury was higher than the yield on the 10-year. And you can see recession soon followed, right? Indicated by the gray bars. Now, the difficulty here is you can see, for example, right before the 2020 recession, that it got really close. The actual graph that I'm looking at here shows it just barely hitting exactly 0.00, but it didn't fully invert. Okay, and so when I did academic research on this, the inverted yield curve is a leading indicator of an impending recession. The academic literature was saying the preferred measure, the one that has a better track record in terms of minimizing false positives and false negatives, was looking at the 10-year minus the 3-month. Okay, and so that's what we're looking at right now, this new chart. And so you can see here, there's no false negatives, as it were. Or in other words, when a recession is coming, the thing definitely inverts. All right. In particular, before the 2020 COVID recession, the yield curve, if you're looking at the 10-year minus the 3-month, did invert prior to that. Okay. And so of the two, the 10-year minus the 2-year is now back in non-inverted territory, right? So it's upward sloping again. Or in other words, the yield on the 10-year now is higher than it is on the 2-year, whereas the 10-year minus the 3-month is still inverted, as this chart is showing you, that it hasn't yet popped up. So you can see those of us talking about the inverted yield curve, and I've been doing this for 2 years at this point, should have been more nuanced on the front end. And so that's my fault. That strictly speaking, it's not merely that, historically, whenever the yield curve has inverted, then there's been an impending recession, but it's inverted and then uninverted before the recession begins. Right, so just looking at this chart, so this chart doesn't go all the way back. This particular chart just goes back to the early 80s, but this pattern holds up. You can go back to the 60s. That's why so many people in the financial press look to the inverted yield curve, because it does have such a good track record. So my point is, it's not merely that looking at this chart, that the blue line dips below that horizontal black line before each of those recession indicators, and it only goes below before a recession, right? So that's why I say it doesn't have false positives or false negatives. It's a one-to-one mapping. But also, the blue line pokes its head back above that black line before those gray bars kick in. Okay, so the yield curve inverts, then it goes back to normal upward sloping, and then the recession begins. And so the difficulty with this cycle that we're in right now, as you can see from this chart, is that the yield curve actually inverted back in fall of 2022 is when this thing first went negative. And then it just stayed there. Okay, so you can see, just eyeballing this chart, that this has been an unusually long duration of the inversion. And so for those of us back when the inversion first happened and we were making back of the envelope forecasts about saying, okay, so this, if history holds up, the recession we should expect to begin, and you start throwing out dates, a lot of us were premature in that, because what we were doing is looking historically, saying every time going back to the 60s, once the yield curve has inverted, what's the duration for when the recession kicks in? And we could say, the longest it was such and such, the shortest was such and such, and you could take, the midpoint, blah, blah, blah. But the problem is this time around, it has just stayed inverted. Okay. And so if instead of the earlier guidance, we had instead been more cautious and just said, well, once it inverts, what you want to do is wait. And then when it uninverts, then there's a real short fuse before the recession kicks in, then we would have been on more solid ground. Okay. Having said that, though, this is now starting to come back up. And specifically, what is driving this, I would say, so now here, we're not just looking at curves and charts, but I'm giving you economic theory, and why I do hang my hat on the inverted yield curve is because it does dovetail with what has been called Austrian business cycle theory. So I'm an economist in the Austrian school tradition, and I think the best explanation I've seen for why the business cycle occurs in market economies was that originally devised by Ludwig von Mises, and then it was elaborated upon by his disciple, if you will, Friedrich Hayek. Hayek actually won the Nobel Prize in 1974, in part for his work on this subject. And so the idea was, very briefly, according to Mises and Hayek, that the banking system pumps in credit that is not backed up by genuine saving, that pushes interest rates artificially low, and that causes an unsustainable boom. And then in a typical cycle, prices start rising rapidly. There's perhaps supply bottlenecks, in various pockets that start arising, and the banks start getting nervous. And so they take their foot off the gas and they don't pump in the flow of artificial credit being channeled in the markets. They restrict. That makes interest rates rise. And then the entrepreneurs have this realization that, credit's not as cheap as it used to be. And a lot of these projects we started, we can't get across the finish line. So they start shutting down, the most unprofitable ones, laying off workers and so forth. And then that's when the recession kicks in. All right. So that was the standard. Again, I'm saying it very glibly here, just for the purposes of this video. Obviously, it would be much more technical and rigorous if you went in and read the actual papers from Mises and Hayek. So that's the basic idea. As far as I know, Mises and Hayek never connected their theory with the pattern of an inverted yield curve. But when I discovered that pattern, I don't mean I was the first person to find it. I just meant when I stumbled upon the literature talking about it, I made the connection with Austrian business cycle theory. Also, I'm not the first person to do this. I think Paul Swick, his doctoral dissertation was on this very idea. But I'm pretty sure it was independent that I thought of it, when I encountered this, and I think Paul did as well. But the point is that it makes sense. So if you independently believed in Austrian business cycle theory, the fact that the yield curve inverts before a recession kind of just pops out of that. It's not surprising. And the intuition is, during the unsustainable boom period in the Austrian terminology, what would you think the yield curve would look like? So remember, this is a phase when the banking system, fueled by the central bank, if that's in the cards, is pumping in credit that's not backed up by genuine saving, and it's pushing interest rates to artificially low levels. Well, if you say, okay, but there's multiple interest rates, right? There's a whole yield curve, a length of different maturities. So when you say the banking system pushes down interest rates to artificially low levels, which interest rates do you mean? And among economists, it's generally accepted that the banks, especially the central bank, have more discretion. They have more control over short-term rates. And so to say that they pump in new money and that pushes down interest rates, you would expect that to push down short-term rates. And it might even have the opposite effect on long rates. Because if they're pumping in a bunch of new money, which is the mechanism historically by which they manipulate interest rates, that's going to raise investors' long-term expectations of price inflation. Right there, if the central bank comes in and starts buying up a bunch of bonds right now, there's like a two-pronged impact. On the one hand, the bond buying tends to push down yields, right? Because bond prices move the opposite way as bond yields. But on the other hand, if the way they're doing that is by creating all this new money, which is how the central bank works, well, then all that new money getting pumped into the system, people are going to think over time that's going to make prices in general rise. And so if you're making a 30-year loan, if you think prices are going to rise more over the next 30 years than you did before the central bank changed its policy, now you're going to update your forecast and you're going to say, I'm going to insist on a higher nominal yield on my 30-year loan because I expect prices to rise more over the next 30 years than I did before I got this new information about the central bank's policy. Okay, so that's why economists think that central bank changes in monetary policy can sometimes have opposite impacts on the different ends of the yield curve. So if the central bank is being looser more liberal in its policy, more accommodative, these are all terms that are used interchangeably in this arena, then that tends to push down short-term rates, and it might even push up long-term rates. And then vice versa, if the central bank slams on the brakes and it stops the flow of new money into the system, or what's the same thing if it starts selling off its bonds, and so it gets rid of the bonds and then sucks money out in the act of doing so, well, then that tends to raise short rates, but it might actually push down long-term rates, both because people expect less inflation and because they might say, oh, if the central bank is tightening, that might lower long-term growth. And so that's another reason you might expect yields to be lower on 10, 20, and 30-year bonds. Okay? So now that I've just given you that sort of refresher to see how those two interact, the standard Austrian business cycle theory with this observed empirical pattern that the yield curve tends to invert before recessions, they kind of go together. And so during the unsustainable boom phase, the banking system's pushing in credit, pushing interest rates to artificial levels, pushing short rates to artificial levels. It might even be raising longer rates. So the yield curve's upward sloping during the unsustainable boom. Then when the banks get nervous and skittish and they slam on the brakes, that makes short rates spike upward. Long rates might actually come down. And so that's why the yield curve inverts. So now the critical thing, what makes the yield curve go back to quote normal and being upward sloping? It's after a period of tightening when the central bank relents and says, okay, we've tightened for long enough. Now the economy is exhibiting softness and or consumer price inflation is back under control. So now let's relax. Let's start cutting rates again. And so that's where we are now. That just happened in September, where the Fed finally started cutting rates, in fact, by 50 basis points. Okay, so that's the story I would tell, the context to explain where we are in the yield curve. So the 10-year minus the 2-year already has uninverted, but I think even the 10-year minus the 3-month is going to finally get back into quote normal territory and uninvert. And just to underscore that, let's go ahead and look at the actual data about the yield curve, the different maturities on the treasuries. So this table is showing the evolution of the Treasury yield curve during September of 2024 with the date when the Fed announced its 50 basis point rate cut. I've highlighted it in gray. Okay, so you can just see here, the different columns are showing the different maturities, and this last two columns is showing the spread. So the second from the right column is the 10-year minus the 3-month, and the rightmost column is the 10-year minus the 2-year. So for one thing, look at the federal funds, the first column there. You can see it was stuck at 5.33. So the federal funds rate is the rate that commercial banks charge each other for overnight loans of reserves. All right, so that's the Fed's policy rate. So that was at 5.33 early September all the way up. Again, on September 18th, the Fed announced it was going to cut rates. And then you see the next day and thereafter, the Fed funds rate dropped from 5.33 down to 4.83, reflecting that 50 basis point cut. You can see, let's look at the 3-month yield, that column. It started the month at 5.19, and it was gently coming down, and then it dropped pretty significantly once that announcement kicked in, and now it's much below that. All right. In contrast, with the 10-year, it was drifting down a little bit, and then it actually jumped up once the Fed announcement occurred. You can see the day before the announcement, it was at 3.65. It jumped to 3.7 and then 3.73 going through the announcement. Okay. And so as far as the spreads, which captures the yield curve information, you can see that the 10-year minus the 3-month, at the start of the month, it was at negative 1.35. It bounced around a little bit, but it was still negative 1.3. Then the day of the announcement, it rose to negative 1.14. And then the next day it was negative 1.07. And now it's at negative 1.02. All right. And then the 10-year minus the 2-year, that last column, you can see it started out a little bit negative. And then now by the end of the month, it's positive. And again, there was a big jump through the announcement. Okay. So this all dovetails with the basic story that I walked you through earlier, just showing that given the Fed's cutting now, the 10-year minus the 2-year already is now in positive territory, and the 10-year minus the 3-month, it's still negative, but it's moving back up towards the 0 point. And then we can also glean some more information from the bond markets here. So if you think about it, there's a relationship between like the Fed funds rate on the one hand and the 3-month. And so the fact that the 3-month yield now is below, so right, the latest data here that I've got posted as of September 20th, the 3-month, which again started the month at 5.19 and now it's down to 4.75. So notice that 4.75 is below the Fed funds rate of 4.83. And so how can that be? Well, I think it's because people are expecting a further cut, right? And so they're thinking in the next 3 months, the Fed's probably going to cut again. And so that's why right now investors lending money for 3 months are getting slightly less than just the current spot rate, as it were. All right. So you can sort of back out information that way. And in general, how can it be that the yield curve is inverted in general? Why would the short rate be higher than the long rate? It's because investors are predicting that at some point in the future, the Fed's going to cut. Otherwise, there'd be arbitrage opportunities if you didn't think that. Right. So that's kind of how that stuff all fits together, that in the short term, rates can be higher, but if the longer rates are lower, if the yields on them are lower, annualized, of course, is what I'm speaking here, then that means people must think the short rate is going to come down in the future, because otherwise you could just keep rolling your money over. If people thought, let me put it this way, to make sure I'm getting the point across. If people thought, now that the Fed's cut and the federal funds rate is 4.83, if people thought that was just what it was going to be for the next 5 years, you wouldn't expect to see the yield on the 3 months right now being 4.75, and you certainly wouldn't expect the 2-year yield to be 3.55. You say, well, people could just keep rolling their money over and earning a 4.83. So how can the 2-year yield be down at 3.55? It's because they don't think the federal funds rate is going to stay at 4.83 over the next several years. They think, no, that's coming down over time. Okay, so that's kind of how this stuff all fits together and ties into the basic story that we've been telling here, the InFi podcast, and in my writings at the Infineo website. By the way, there's going to be an article there, if you check the notes for this episode, if you want to see me walk through all this stuff and spell it out and you want to just study these graphs, at your convenience, I'll have it all there, sort of distilling down what I went through in this episode. Okay, so big picture, just a recap. I still believe a recession is imminent at this point, but I do think, just to clarify, that when the fuse is very short, I believe that the 10-year minus the 3-month will be back in positive territory. Okay, so we're not there yet, but I think especially if the Fed cuts rates again at some point in the near future, then you're definitely going to see the 10-year yield being higher than the 3-month. And then that's typically when there's a very short window before the official recession begins. Even there, just keep in mind, the economy can be in recession and it's not known yet, right? That when these gray bars get shaded in because the NBER, the National Bureau of Economic Research, says, yep, there's a recession. That's when it started. That's always looking backwards, right? Because there's data that come in over time, and that it's only in retrospect that the NBER officially dates the start of a recession and the end of a recession. Okay, so we may be in a recession before the government officially announces it, but it's still, that's no consolation to you if we're in a recession, that you need to be planning ahead of time. Okay, and then again, what I talked about at the beginning of this episode, another indicator that's completely independent of the bond markets is the so-called Sahm rule, which just looks at the trends in unemployment. And according to that indicator as well, it has now moved up to a level such that going back to 1960, anytime it had reached this level, there was a recession that was imminent. Okay, so just another independent line of argumentation to show that according to the conventional measures we use, a recession is imminent. Last point I will mention, just to give some color as to, okay, the one kind of weird, squirrely thing in all this, Murphy, was how come the yield curve has been inverted for so long, right? Like, and that's kind of what threw people off on the beginning. Once it inverted, they said, oh yeah, but recession's coming. And then it looked like that was a premature call. Well, it was a premature call because, hey, where's the recession? I thought a recession was coming. And lots of people, not just the Austrians, but in general, lots of people thought once the Fed started hiking that we were going to tip into a recession and that it should have been here by now. And people have been surprised by how well the labor market has held up, right? Like the official unemployment numbers had been pretty good for a while. Now they're marching upward, but people were somewhat surprised by how long the economy lasted in the face of those aggressive rate hikes by the Fed. And so those two things kind of explain each other, right? That the reason historically, I think the yield curve first inverts and then uninverts, and then the recession begins. It's not that the uninversion caused the recession in a mechanical cause and effect relationship. I think rather what's going on, it's more accurate to say it was pumping in the artificial credit that caused the unsustainable boom, then turning that off allowed the malinvestments, to use the Austrian lingo, to manifest themselves. And so that's why entrepreneurs started laying off workers and resources get reallocated and so on. And that's when the recession officially begins. And so it's going into that, right? When there's the credit tightening, businesses respond, start laying off workers and so forth. And then seeing that softness and that the fact that the economy is tipping into recession, the Fed tries to get ahead of that and they start cutting rates. And so that's why when you look at the data in these historical charts, you see that the yield curve inverts, then it uninverts, and then the recession begins. Again, it's not that the uninversion literally causes the recession. It's rather, it was the normal upward sloping phase of the yield curve that caused this unsustainable boom. And then when the Fed started tightening, that's when the economy starts tipping into recession. And it's just as that process unfolds, the Fed sees that coming and then cuts rates, and that's what causes the uninversion. So this time around, for whatever reason, after pumping in all that artificial credit around COVID and so forth, that causes unsustainable boom. Then the Fed started tightening. And because the economy did not immediately tip into recession, that's why the Fed didn't need to cut rates. It was trying to still get consumer price inflation under control. And since unemployment wasn't spiking, they were like, well, let's just keep short rates high because CPI inflation is still higher than we want it to be. But there seems to be no reason to loosen right now. And so that's why they kept short rates so high. And that's why the yield curve has remained inverted this whole time or for such a long time. All right. So I'm not here explaining why is it that the economy has lasted so long before tipping into recession, but I am saying that's partly why it's like two sides of the same coin. The reason the yield curve has stayed inverted this long is because the economy didn't tip into recession following the Fed tightening as quickly as it historically has. Okay. And so to explain one aspect of that is to automatically explain the other side of that coin. I can speculate, and we need more data, and I would need to study it more to say anything with confidence, but I would not be surprised if the reason, quote, this time was different in the sense of the Fed dropped in boatloads of money, way more than historically is normal, and then tightened very aggressively compared to historical patterns, and that the economy did not tip into recession immediately. There's several factors going on. So one thing is the labor market is really screwed up right now. So even though the official unemployment rate is still modest by historical standards, the percent of people in the labor force is unusually low still. Okay, so that's one squirrely thing going on here, is that the unemployment rate might be misleadingly low, put it that way. But beyond that, just how unusual the last recession was in this cycle has been, right? Where the government literally ordered people to stay home during the lockdowns, and then other governments around the world did likewise. So that totally screwed up all the supply chains. And then there were all the stimulus checks, and then to relax all that. So I think partly what may have happened is this wasn't simply a bank-driven boom and then bust. There were some other, quote, real things going on that contributed to this pattern. And so I think that might partly explain how was it the economy, in the face of these headwinds of enormous rate hikes and the Fed even letting its balance sheet shrink and M2 actually dropping, which is not normal. Usually it's just the rate of M2 increase slows, but in this cycle, M2 actually came down. So one might have thought, geez, with all that aggressive Fed tightening, how come the economy didn't fall off a cliff already? And I'm saying it might partly be because workers were literally ordered to stay home and then they were allowed to go back to work. And so it's possible that that was so expansionary that the Fed contraction overlaid with the world economy opening back up gave us more leeway than we normally would have had if it was just a regular economy baseline. And then you had this central bank cycle dropped on top of that. Okay, but this last part I'm saying here is just my musings to explain why might it be that this last time the economy has lasted so long in the face of Fed tightening, whereas historically we would have already been in recession by now. But be that as may, what I am more confident in saying is, given that the economy did hang on this long, that explains why the yield curve has remained inverted. Because again, what makes it uninvert is that the Fed sees softness and then starts cutting rates to try to get ahead of that. But now we finally are in that phase. The Fed just cut rates, and not just a little bit. They cut rates 50 basis points, I think, because they realize that the economy is in store for some pretty bad shocks. Okay, so I will wrap it up there. As always, folks, thanks for your attention, and stay tuned, and we will give further updates as more information becomes available. See you next time.